Who's first time in Qatar? Yeah, so majority of people. Yeah, I'll introduce myself, and I got a guest speaker last minute here. But before doing that, I just wanted to get to know you first, quickly. How many of you are first-time founders? Okay. How many of you, have raised more than $1 million before? So the rest, I assume, less than 1 million. Yeah. How many have not raised any rounds before of investments? Okay. Yeah. How many have raised angel investments? Angel investments. Anyone raised like a seed or Series A? Okay. How many from the MENA region? How many outside the MENA region? Yeah, very, very diverse group. Yeah, so this talk is, mainly about, fundraising tips. Quick introductions about myself. My name is Amir. I'm based in Egypt, between Egypt and Saudi Arabia. I was a founder of a online recruitment platform in Egypt called Wazzaf. I started in 2009. Yeah, spent, first time we launched our platform was in 2011. We launched our platform, and next week we had the Arab Spring and the revolution in our country. So I had to bootstrap for a couple of years, then managed to be the first startup from Egypt and one of the first from the region to raise funding from 500 startups in San Francisco before they came to our region. Then I raised a couple of other rounds, raised more than $12 million, 2015 and 18, back again when it was a bit early in the region. And then COVID hit. I had to take a sort of a completely burnt out, needed to take a break. So I took a 2-year break, mostly doing VC. Joined the fund in Saudi Arabia called Khwarizmi Ventures for the past 2 years as a partner. But now I'm going back to the startup life again, doing both hats, VC and entrepreneur. And today I'm gonna give you some tips and tricks about fundraising. And I have a guest speaker with me, a fellow friend and colleague, and he's actually my first investor. 10 years ago, he was like an angel investor, then a VC investor in my company. Tariq Fahim is one of the early investors in Careem, which is was like the Uber of the region. Then got acquired by Uber, and many other companies in Egypt and abroad and across the region. Quick intro, Tariq.
Yeah, thank you, Amir. Pleasure meeting you all. We all now heard from Amir. When an entrepreneur gets tired and wants to take a vacation, he works as a VC. So this is basically what I do. I'm a software engineer by education. I started as an angel investor. Later on, I had my first fund. We invested half of our portfolio companies in the US and Europe, and the other half out of the Middle East. It worked for us really well to connect companies between here and there. So basically, our first unicorn was Careem. We're in a seed investor primarily. We typically write the guys their first checks at Series A. Our second unicorn was Boom Supersonic, the guys who are building the new Concorde out of the US. But the reason actually we managed to get into that one, that we got on Qatar Airways from here. So again, it works connecting here and there. It really works as a thesis. Our third unicorn was actually an Egyptian Canadian. So that again is between the two worlds. Our fourth actually was a write-off. We almost wrote it off in our reports. Suddenly they sent us, hey, we just a unicorn. We just raised $250 million in the AI frenzy. So it tells you something. Many of the times investors are clueless. If you are writing a company off and then getting to a unicorn, it tells you how much we're thinking. In general, before we start, everything in the details and the tips that we'll be getting from Amir and some comments from myself, remember this, investors have a judgment that's almost less or equal to a broken clock. How many times a broken clock give you the right answer or right hours? Twice. So twice out of what? 24. So what's the percentage of that? Any good in maths? 2 out of 24. 8%. You know how many companies at seed stage generates outsized returns? 2% if you're not that good, 5% if you're average. So the average, or almost a good investor, has a judgment worse than a broken clock. Just remember that every time you raise from an investor.
So yeah, good introduction. And actually, I had like a list of 10 tips, and Tarek reminded me of first tip right now is a lot of investors are indeed clueless. Yeah, and as a founder, I used to think that how many here are investors? Any investors? Okay.
We can speak freely.
So as a founder, I always, I met so many. I probably pitched more than 100 investors in the early days, all with rejections. I always thought that probably those guys, they know more than I do. They understand, business and startups more than I do. Until I moved to the VC side, and I discovered that, a lot of investors, they don't know what, they keep asking very smart questions, but most of them don't know your industry, or as well as you should. In most cases, the founders are the experts, and in many cases where you see, investors asking questions, some of them, just, irrelevant questions, or probably founder. Most of the case, I would say, usually are right. But yeah, so that's one part. So my number one tip about fundraising is actually, the best fundraising, best investor is actually, it's not to fundraise at all. It's actually clients. If you can finance your business with actual paying clients, that would be actually my number one tip, and avoid investors altogether. I think, previously, before having VCs and tech investors, businesses did exist. So, companies can't exist without investors, but investors can't exist without good companies and founders. So, number one tip would be to try to get revenue. If you can get revenue, that's your best chance. And if you are able to get revenue and bootstrap your company to some sort of traction or revenue, that's actually your number one strongest selling point to investors. And Tarek, if you have any comment on any of my tips, just even if you disagree.
I don't disagree. I think the best money is the customer's money, definitely. More than the investors. And every investor would agree with that as well. Like most of the investors don't like to give you money if you're gonna die without their money, because just put yourself in their shoes. If somebody came to you and say, you should give me money. Why? Because I'll die here without you. Would you give him money? Just think about it. Most of the time, you will give people money, or you give companies money, if they say, with or without you, we can live. It's just a matter of accelerating our growth and achieving higher potential faster. This is the main message that you should be telling your investor. Otherwise, he will be afraid to invest, especially back to the point number one, most of the investors don't know your industry well. And again, startups, fast growth startups specifically, is a business of anomaly. That means whatever the typical logic about startups or about business can be in a way, but in startups should be different, because you have a different point of view, so you need to prove it. It's a matter of finding the right investor at the early beginning who would have or would believe in your point of view. This is the most important thing. And for that, back to the concept of revenues, you have say windows. If it's better to raise with no revenues at all at the very early beginning, a small check, than to raise with a very small revenues. Because sometimes some products, some product guys, because they can hack anything, they can write code, they can do a lot of other things. They reach to a certain level, say, yeah, I'm not ready to talk to investors yet, I'm still building my products. Great. When he built his product, now he thinks investor will come. No, actually investor will not come, because you will go to the investor and say, this is a product, look at my demo, it's great. So he will ask you, Where are your clients? You said, like, we just did one, like, whatever, 50K revenues for the past 1 year. This is bad. You would have in a much better position to raise more money without revenues at the early beginning, just showing the prototype. But again, this is type of investors, like angels, like accelerators. And the second best position to raise early on is when you have a high growth in revenues, but yet still your revenues is early on. This is second. Show the traction, show the growth. I think that would be your next point.
Yeah, and we'll continue talking for another 20 minutes, but then we'll take questions, so please, take them down, write them down. So my next, tip is actually, every investor is different. Okay, so Tariq is a very dear friend, but then we all have, we do look at companies and we evaluate businesses very differently. Some people usually say, like, investors like to see that, or investors like to do that, and this is usually like stereotyping all investors into one thing, but every investor at the end is a human being, and we're all different, and we have different views of the world. And even within the same fund, sometimes people think that within a certain fund, all people are looking for the same thing, and usually even within a single fund, you'll have different partners and different people in the team structure, investment teams, and they have different views. So part of it, and you're a very diverse group. We'll try to speak, to people who target angels, but also people who would target early stage VCs. Again, quickly about, any angels. I think if you are looking for, like, to raise 50, 100, 200, up to 500K in most geographies, this is where you go to angel investors. And usually angel investors, they invest in you as a person. They're excited about you. This is usually like most angel investors would not look at very detailed forecast and so on. They are investing in you as a person, as an entrepreneur. And then, of course, there are the accelerator type, and then there are the early stage VCs. And most VCs are, the ones I know, again, tickets from 100K up to like 5 million, 10 million, sometimes for early stage investors. And those are, a bit more sophisticated. And every different fund, they have different weights. Some people, every different person, sometimes people look at, the team first, sometimes people look at the market first, so it's very different from one investor to the other. Your best, tip is not just to read what's on the website, it's actually to speak to other founders this investor has invested with, and this is like your best way to understand this specific investor. And
Amir, if you allow me in here, this is actually a great tip. Don't just look at the website, because most of the time people would write on the website the things they would aspire to do, not actually the things that they do. Everybody's saying that we add a lot of value, we blah blah blah, deep tech and all those kinds of things. In reality, not necessarily they're doing so. So the best thing is actually, as Amir said, to talk to the founders themselves. And when you talk to the founders, ask them, especially if they are successful founders and you manage to get to them, ask them to do introduction to the VC. First, they will give you some hints how to deal with that specific partner within the VC. Second, getting a good referral from an entrepreneur that I trust, I invested in, is much better than getting a cold mail.
Yeah, about this part also.
Amir gave me breakfast, by the way. He was the one suggested that I should invest early on in breakfast.
Breakfast is the largest grocery platform in Egypt, now in Saudi as well.
So it was Amir for me. This is how it works.
So also another important fact to know when dealing with investors is that most of them, as a founder, I used to reach out to a lot of investors, stalk them in events and so on. And it was, very frustrating, people don't reply and so on. And usually it's the problem when I went on the investor side is that it's just too much noise. Like in our fund, Khwarizmi Ventures, we get more than, so we usually get like more than 2,000 pitch decks per year. That's a huge number of applications. And every single pitch deck has a trajectory in charts going up to the right. Every single pitch deck is promising a unicorn. Every single pitch deck shows like the world-class team. But it's the job of investors is difficult in that part because it's a lot of noise and it's very difficult to identify the right founder. Sometimes there are great companies, but just they get lost in the large number of pitch decks that come along. That's why it's extremely important to try always to get warm introductions. So instead of me going through, or an investor going through 1,000 pitch decks, if you go through a warm introduction, meaning not a cold email or just randomly at an event, usually through a trusted connection, and this is how most investors operate. When they get a connection, if Tarek, for example, tells me, Amir, this is a company you should look at, I would definitely look at that. And the same way, this is how most investors operate. You need to build the relationship with enough people in the ecosystem, and not just investors, but other founders, because this is a people business, people investing in people, and a big part of it is your reputation with even other founders, being collaborative, supporting other founders, and so on, because investors will ask about you, and you want everyone you deal with to give positive feedback about yourself. Usually this is very important. Any comment or?
No, actually, your reputation matters.
Yeah, another part, also about the same way every pitch deck says amazing stuff about every company. This is what Tarek mentioned about their websites. Every investor says they're founder friendly, they're quick, they're fast, and like 90% of investors are not like that, as they aspire to do. That's why it's the most important thing is actually asking about investors before you bring them along. Another tip also that's not that common is that when you're talking to a VC fund, like an early stage fund, usually it's a team. Usually there's, the usual structure is there are, partners. These are the most senior people in any fund. There are like associates or principals who are right below the partners, and then there are analysts and senior analysts who are the junior people. Most people only like to talk to the partners because those are the people who are, most well known in any ecosystem. But usually they're the ones with, most incoming messages and too much noise. Most people ignore like the second and third layers, but my advice would be actually to also try your luck with the junior team members. You'll have more time to if you can get someone to really listen to, usually you have more time and they can bring it up. So, but again, warm introductions through partners is usually the best one. Yeah, my other tip is about the efforts of fundraising. It's like a full-time job. Usually it's most difficult for solo founders. How many here are solo founders? Yeah, so those people will have the most difficult time with fundraising. I was a solo founder, and usually when you're fundraising, you're not focusing on the business. Better to keep that short, or if you're early stage enough, you should consider bringing in either a co-founder, lead co-founder, C-level person to help you with the fundraising. In my Series A, I did that. I brought someone. I'm a product and tech person initially, so I got someone ex-Harvard, MBA, consulting background. She came with the company for period of time. She really helped us and helped talking to investors. And also what I discovered is that with most investors, conversations between founders and investors usually speak very different languages. Majority of investors, especially in emerging markets, are people from investment and finance background, whereas I think in the Silicon Valley, for example, it's like a 50-50 between operating partners and people with finance and investment background. So it's people can speak the same language much easier. But this is also one part of understanding the investors, not just the fund, but the individual you're talking to. What's their background? If their background is like investment and finance and so on, most likely they'll want to see financial models and look at numbers, market sizing, and so on. And usually, if you're talking to an operating partner with startup experience, it will be mostly focused on they'll look more about the product and the product market fit and so on. Anything to add?
Yes, about the timing, that it takes you to fundraise and how it's a full-time job. It's not only a full-time job, it's a full-time job, and it's it's roller coaster. Sometimes you feel, I'm done, he's signing, that's it. Next day, you get like a very, very cold treatment. He's ghosting you. He's not even replying to your emails, things like that. So what's really happened? Most of the investors don't like to say no. This is a fact. They like to keep good relation with the founders. Why? They are not super convinced, but if they wait enough, maybe somebody else will come in and put some money, something happened and their traction, thing like that, and said, okay, yes, now I can invest, now I have more conviction. So for that, on the other side, you're hanging, you are like going ups and downs, so it's not only time consuming, it's a psychological burden. For that, if anybody decided and you agreed with him that he's going to be investing, before you do your investment, prepare your closing documents. And in case of you doing like a bigger round, you're doing it on convertible notes. Convertible notes, are you familiar with convertible notes? Perfect. So not all investors need to come all at once because it's not a price round. You can start sending their convertible note. You say, okay, you're in, great. Next email, there's a convertible note, this is the time, please sign it. If you sign it, he's in. If you didn't sign it, he's out. Don't think, yeah, he didn't see it, maybe it's got in the email. No, he's out. Because if he didn't sign it. So this is the thing. Use convertible notes, get commitments, close it as fast as you can. If you wait for another week or 2 weeks till you get the other investors to invest in that, to be leading you around, blah, 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 you might be losing the first or the couple of first investors who committed with you, either as angels or VCs. So it's hectic, it takes a big time, but anything that takes a longer period of time, you start breaking it into phases. You start breaking it into smaller steps and achieve one step after another. So prepare your docs. If you said he's in, send him the docs. That's it. And maybe later on, if it's even a surprise round, you can convert all of that into a price round later on when the other lead investors come in, for example. And there's a lot of terms that can be put to make sure that whomever wrote you the convertible note is not in a disadvantaged position by any means if that didn't go through, or some other lead investors would come in with a preferred terms or things like that, almost at the same round. All this covered, most important thing, get them to sign.
Yeah. Another tip, I think, which is new to the market, in my opinion, is you need to know your geopolitics, because now it's like it's in everything. If you're like, for example, if you're in this region or even globally, if you get like if you're doing like hardware or deep tech and you have like Chinese investors, you probably can't get US investors at the same time. If you're in the region, whether you're targeting Saudi or UAE or other markets, sometimes it's the dynamics are, you need to talk to a lot of other founders who tried raising from this market. A lot of people, I think, from the whole world are coming to the region, excited about the region. You need to talk to other founders, understand the dynamics between different markets, and every market is very different, but this is very important. Another part is that I see a lot, and usually is a very common advice I give to founders, is regarding valuations. A lot of founders keep optimizing on valuations early on more than they should, and this usually makes their fundraising extend for much longer, and usually comes with more complicated terms. My advice is to be as flexible as possible. In my opinion, it's something that when you see as a founder, you see all the PR and all the announcements everywhere of other founders, other startups raising a ton of money. Usually it's a lot of pressure, but in a lot of cases what I discovered is that a lot of those companies that fund a lot of money, from the outside it looks great, from the inside usually it's not the same. You don't just follow the PR, follow what other companies are doing. You need to follow what you think is right, what makes sense. That's one. And what else? And another tip which is very important, is to be yourself when you're talking to investors. some people try to, show this image, that, I'm a very tough guy, I know what I'm doing, and overpromise and oversell. Usually this ends up with, issues down the road, even if those investors join. You need to be yourself, because you'll probably be interacting with this investor for so many years. And you can't play this role forever, and you need to, once the investor is in, you need to, just, be transparent about the issues, the challenges, and so on. Don't try to cover up things, because again, this will hurt your reputation. As we mentioned in the start, it's super important. Anything here?
It's important, and it's important to actually, you already got him, he's an investor. Guess what? That might not be the last check he writes to you. So you better make sure that he writes more checks to you, because if this is a fund or multi-stage fund, he will continue maybe supporting you till IPO or till exit. So how you can do that? As just Amy said, by continuous reporting and communication, the good and bad. The best companies in our portfolio, this is like the best indicator we have. Sometimes we had companies that raised a lot of money and then later on almost busted. Almost went to zero. But the best indicator for the best founders, or the best companies that we had, those companies, you can know the date exactly of the month by reading their by update. There's a monthly update. It's the first day of the month when you read their email. They send you a monthly update saying this is what happened, this is what's bad, even if it's a short update. But they send you monthly update, or they send you quarterly update. Regardless, as long as you agreed to something specific, they are very punctual and very consistent in sending their updates, the goods and bads. The worst kind of founders, I know we all like to be that kind in one way or another, is the kind that only brings good news. So I will not share bad news, not because I'm malicious or trying to hide things, but I don't like sharing bad news. I like to, I can fix that. Maybe I can fix it this month, maybe I can fix it in 2 weeks, 3 weeks, and then I'll send an update. Believe me, this is bad, and will not help you to raise more money from the same investors.
Yeah, and my final quick tip, and then we will open it up for questions, is to enjoy the journey of being a founder. Fundraising is just one part of it. I think fundraising is defines maybe 10-20% maximum of a company's success. And be ready to accept a lot of rejections and no's. It's totally fine. It's like marriage. There's the right people, and then there are other ones, and you don't want to bring in the wrong partners. And that's my quick tips. If you have any questions, throw them at me. Yeah, please.